Hi, everyone, and welcome. We're thrilled to have you join us today. My name is Amanda DeTrolio, and I'm the Director of Marketing and Platform here at Flare Capital. Flare Capital is a venture firm dedicated to investing in early stage companies at the intersection of healthcare and technology. We're excited to host you for our quarterly expert roundtable. Today's focus is on DNA dealmaking, learnings from HealthTech's elite dealmakers and founders. HealthTech's Dealmakers are beginning to reshape what growth and exit pathways look like and are setting the stage for a new wave of exciting liquidity opportunities across the sector. Today, we'll frame the market backdrop they're operating in, specifically the early signs of a rebound in deal flow, recalibrating valuations, and shifting buyer priorities. Before we dive in, a couple of notes. We're recording today's session, and it'll be posted on our website soon after. Feel free to revisit or share it with colleagues. We host these roundtables every quarter to spotlight the important trends shaping healthcare innovation. We hope you find today's discussion valuable, and as always, we'd love to continue the conversation afterwards. I want to ground us in the data behind this momentum. Starting with the first chart, we see exit activity is meaningfully higher year over year, even if not yet at peak levels, signaling that the market is reopening and buyers are re-engaging after a slower 2023. M&A is driving most of the improvement by deal count, with a noticeable increase in smaller tuck-in acquisitions that indicate strategic buyers are prioritizing capability expansion and integration opportunities over large, high-risk bets. We also should acknowledge another pressure dynamic. In the second chart, we see secondary transaction volumes accelerate to record levels in 2025. With so much of investors' capital still locked in late-stage private companies, we're seeing real momentum to find creative liquidity pathways for investors, positioning secondaries as one of the most attractive and necessary release valves in the market today. Let's move on to the next slide. Now let's look at the deals behind the numbers. What you see here is a snapshot of the headline-making transactions from 2025. A mix of strategic tuck-in acquisitions, structured secondaries, and private equity-backed roll-ups that are reshaping the competitive landscape as investors and founders seek out liquidity. These moves illustrate how both strategic and financial sponsors are getting increasingly creative in pursuing growth, whether through capability expansion, consolidation, or new platform formation. One notable example includes New Mountain Capital's formation of Smarter Technologies, which combines Smarter companies by Flare Capital and two other strategic assets. We also saw rapid acceleration of acquisitions by growth stage businesses, including Fabric, Datavan, and Machinify, whose leaders we have here with us today. And importantly, we also saw two meaningful IPOs from Omada and Hinge Health, signaling that while the IPO window isn't fully open, there is growing appetite for public market debuts when the fundamentals are strong. To dive deeper into these trends, we are sitting down with the deal makers behind the headlines. We have 6 fantastic leaders joining us today. They bring experience from across the healthcare technology ecosystem, including leading investment banks, private equity firms, and startups. We'll start with an investor panel featuring Catherine Wood, partner at TPG, Nick Rickett, global co-head of healthcare services at JP Morgan, Robert Vorhoff, managing director and global head of healthcare at General Atlantic. After that, we'll shift to our innovators panel featuring Anik Rahman, founder and CEO of Fabric, David Pierre, CEO of Machinify, and Kyle Armbruster, CEO of Datavan. So with that, I'm going to pass it over to my partner, Michael, to welcome our first panelist. Michael, over to you.
Hey, thanks so much, Amanda. I couldn't be more excited about who we have on this first session of the panel. As Amanda mentioned, Rob Vorhoff from General Atlantic, Nick Rickett runs global healthcare services at JP Morgan, and Catherine Wood, healthcare partner at TPG. Before we get into the question, I'm going to just let each of you briefly introduce yourself, maybe comment a little bit on how you view the healthcare opportunity set. And maybe I'll go, Rob, maybe I'll kick off with you.
Sure. Hi, everybody. Good afternoon on the East Coast. Rob Vorhoff, I lead healthcare investing at General Atlantic, as Mr. Greeley mentioned. I've been with the firm for 22 years and leading our healthcare efforts for about the last 11. GA is a global growth equity investor with a relatively broad mandate from minority growth investing to minority recapitalizations to growth buyout. 90% of our portfolio is digital. That's across all sectors, including healthcare. And we look for the organic growth of our companies to be the primary economic driver of the returns we are trying to deliver to our investors.
Terrific. Catherine, maybe over to you.
Great. Good to see everybody. I'm Catherine Wood. I co-lead our healthcare team out of TPG Capital, which is our late stage private equity investing business. TPG itself is a broad alternatives firm. We have about a quarter trillion, but from the very beginning, healthcare and tech have been our two most active areas across many different strategies. So the intersection has been really important and not too dissimilar to what Rob said, but we look for growth oriented transformation. So situations where companies that are important in their markets and have a lot of secular growth, but where capital and resources can help them even accelerate that further. So I think that a big part of that has been add-ons to our companies where it's new capabilities that again can maybe they're not financially accretive day one, but they're very strategically accretive so that a business when we buy it looks very different at the end a number of years later.
Terrific. And to one of my favorite investment bankers.
There we go. Well, Nick Richard, I am JP Morgan's global co-head of healthcare services investment banking, 25-year career banker. Title's a little bit of a misnomer. I do spend 80% of my time in health tech. I've been active across the vertical, as I think of it, for most of my career, going back to the early days of digital health, the early days of paper conversion to digital, the whole SaaS cycle, and now this really fun AI cycle we're all in.
Terrific. All right. So as Amanda teed us up, we're really going to talk about liquidity and some trends we see. So I guess the question that a lot of us are asking are the signals we're seeing at the end of 25. Is that a sort of a false positive signal where there's an uptick in M&A activity? Maybe each of you just characterize what you think we're seeing in the market today around liquidity. And maybe Rob, I'll just turn it over to you. And each of you, I know, have been involved with very successful transactions. So are we on the upswing, do you think, Rob?
I do think we're on the upswing. I don't think it's going back to where it was 3 or 4 years ago. I think we're going to continue to see an opening of the public markets. It's probably most important that the buyers of what is a pretty select few number of IPOs in the latter half of this year make money. And so they keep coming back to the well and supporting IPOs and hopefully an acceleration in the public markets into early 26. For a lot of us, that's not a really efficient or even sometimes attractive path to get liquidity if you're an investor. And what you've seen less of is an increase in the activity of cash buyers. And on this, I think a lot of the strategics have been more on the sidelines from a cash buyer standpoint. And then the sponsors, it's been a bit of the haves and the have-nots. So the really high quality assets have come and garnered great outcomes and have transacted and gotten high values. And then the areas where there's a little less certainty or the diligence isn't as clean or the businesses are not as high of quality, we've seen a number of broken processes this year. Maybe I'll just pause there too.
Yeah, there's a set of attributes and the ones that you think are going to be most successful transacting in this environment that are common to all of them.
I think there is a general level of uncertainty that is an overhang facing most sectors within healthcare right now. The technology companies that touch some of those areas where there is less certainty, it's just, you don't know where those investment committees of the buyer are going to get to once they're at the finish line and how much they worry that uncertainty affects the fundamentals of the business. Those that are more entrenched in less uncertain areas are where you're seeing most of the deals get done and at the higher values. So you think about revenue cycle or you think about specialty EHRs, right? Those are tried and true businesses. They're less exposed to some of the reimbursement or regulatory uncertainty, and you're seeing more transaction volume there as a result.
Yeah. And Catherine, do you think we're in a false positive environment?
No, I strongly agree with two of the things that Rob said. One is that uncertainty is bad for the deal market, right? And so even if things settle at a lower level than where they were in 2020 or 2021, having some clarity that we know where tariffs are going, a number of shoes have dropped, the payers can see their way through to 2026, et cetera. I think that's probably why you're seeing a little bit of an upswing. And I would hope that is durable, although obviously things have been more unpredictable generally than probably we've seen in other years. So I would hope that's durable. I think that as you look at what is interesting, I think that health tech benefits from all the secular trends that we all know, right? Healthcare is pathetically underinvested in technology, and it's part of the solution as you look at all the cost pressures, et cetera. But to Rob's point, I have been actually surprised by some of the higher quality assets, particularly larger companies that haven't traded. And I think that's mostly about not getting the values that
were expected. And part of the reason for that is some of the vintages that are coming out are the 2020, 2021 deals that were done in a different valuation environment. So it'll be interesting to see if the logjam breaks. And I think that's the bifurcation point that Rob was mentioning in terms of the very best things that are clearly AI winners, that are very strong business models, unit economics. I think the buyers have been there shocking prices in some cases. And then the flip side is also true. But I would say on balance, I would be optimistic that because we've settled into a more certain environment and there are just multi-decade tailwinds on health tech, particularly with AI, that we'll continue to see an acceleration.
I think Nick is eager to refute or agree with you.
I think he was blushing where he was on the sell side as those shocking numbers.
I see what he's referencing my deals on those deal values.
I did a deal where Nick told me I was massively overpaying. So, that's okay too.
I do that too. It depends on which side of the transaction I'm on. I do my job.
An honest banker. So it's good.
A lot of good points being raised. We all have to keep in mind that Liberation Day happened. It was real and it was emotional, and it's amazing that some things actually signed that week, like the Health Edge deal, or in the following week, like the Smarter DX deal. But for the most part, it sucked the wind, it held the mojo out of the market for almost 3 months. Bake-Off started to pick back up over the summer. I imagine a lot of the folks listening right now were thinking that they've really picked up again. This market is constructive for the reasons that Catherine said. Stability has come back to the market. Well, the question around false positives is a really good one, because I do think if you're reading the room, you could read that there are more false positives right now. If you just look at health tech or tech generally, market feels really healthy. There are other parts of the market that are not. And by the way, it's not necessarily a rising tide like it was in 2021, where all boats were being lifted. And I've got all sorts of good analogies about water and tides and boats and swimmers from that period of time. I think where the market is most constructive right now is around growing assets. That's a winning strategy, buying growing assets. Growth solves for all sorts of problems. It solves for leverage. It solves for any of the questions that anybody is going to have around risk. And I do think people have been over-indexing. Our higher growing businesses helped us hit some of these multiples north of 20 times EBITDA or north of 20 times revenue, a couple of cases. And look, I do think, it is remarkable that a lot of those businesses, they do deserve those valuations. They've just gone through a 2 to 3 year crucible of business model refinement, go-to-market refinement. I would argue that their investors are going through / coming out of a 2 to 3 year crucible on their own models and how they invest and how they pick which platforms that they're going to invest
So
in.
Nick, in that crucible, at least in our end of the market, more early stage, the pressure went from growth at all costs to get break even profitable on the capital you have. Are you suggesting that we're back at a growth at all cost mindset?
I want to be really careful with how I answer this, because I'm going to cause problems for myself for the next couple of years. Not necessarily. Look, you got to think about who your buyer is, and you got to think about what that universe of buyers looks like and their ability to pay, their ability to absorb losses, their ability to own a break-even business. And I think all the same logic, not the emotionality of growth at any cost, but all the same logic applies where you have scale economics. If you've got high gross margins, if you feel like you have a right to win, like the board might decide. And as a banker, I might say that's the right thing to do, but it's much more situational than it was before. We had businesses with 50% gross margins, 10% gross margins, and we were burning a lot of capital chasing some of these different TAMs. I think that was a little challenging. And by the way, I think a lot of those businesses have now found buyers. Yeah.
And maybe Rob. Yeah, go ahead, Rob.
Can I jump into this? I think that was the right advice to give to early stage companies. And I'm sure you guys started to give that advice years ago when it was even a far less certain environment. I think the investment appetite for doesn't matter if it's high growth, but high burn profile is minimal to zero. And I want to pick back up on something that Catherine said earlier that I think is really important. It's easy for management teams or existing investors, companies to say, we got in at this price or we paid this multiple and we want to get a certain return, or we got to get the same multiple or something close to it coming in, or even if it's just a minimum return. And it's just not relevant at all to how the acquirer or the new investor is going to make the decision. And when we have these conversations specific to sectors, it's easy to forget that the capital is fungible. And a lot of the larger investment organizations are investing across geographies, and across subsectors. And that's absolutely the case for Catherine's firm and mine. And the decision is that the investment committee, there's no quota to say, hey, we got to put this much dollars into healthcare or this amount of capital into healthcare technology. And it's all a competition amongst the various deal teams in different sectors in geos to find or create the most favorable risk reward. If you have more attractive opportunities for that new deployment of capital, then it's going to reset values just to find the most favorable risk reward. And as I think about it, that makes it very hard where you've had years of a lack of liquidity in the system and therefore more pressure on secondary. Whereas I don't feel like firms are saying where we really need to deploy a lot more capital or we're not deploying enough capital. And some of that's our industry's own fundraising challenges. But if you're deploying the amount of capital you want, that is going to go in pursuit of the most favorable risk reward. And if you have years of pent up liquidity demand, that means only the best deals or the best companies are going to get that capital.
Yeah. And
Yeah.
maybe Catherine, there's been such an AI premium attached to a lot of these emerging hypergrowth companies. When do you think that kind of recalibrates and resets 20 times forward ARR, 50 times forward ARR? How does that get rationalized?
Yeah. In my part of the market, specifically in my fund, we're maybe doing a little bit less of that. It's interesting. And we have a fund that does passive minority technology investments. And we've done things like we've invested in each of the big three model companies, saying we have enough humility not to pick a winner, but one of them is probably going to emerge and probably all three of them in different ways. And I think that it's a little bit harder to pick a horse, but if you say these are the profile of companies and the type of business model that we think will succeed, I think that's one way to bridge it. For us at the later stage, I think the way it has shown up is two ways. One is that there's certainly a category of services businesses that feel, at least to us, like it's a little too hard to bound the transformation or feels like the wind is going to come out of the sails in terms of profit pools. But then the other side of that's really exciting, as some of the people on the phone have been involved with, is when you're really transforming a company with the benefit of AI, where it's Rob mentioned RCM, right? Where it's a critical service and clients don't really care too much about how you get there. They just care that their collections increase. And so if you can do that in a way that has fewer people, a lot more technology, that's a super exciting investment thesis. And that's where earlier stage companies can complement maybe an established company that has great customer relationships and put that together and say, wow, that's a really like winning combination. And I'm not saying valuation doesn't matter because it always does. Owning a business, a platform, it's easier to pay a higher price, obviously, for that.
And so maybe just extend that hypothetical. Arguably, there's several dozen scaled assets in our category that are looking to transact. What are some of the innovative ways that you're counseling portfolio companies around liquidity if it's not just an outright sale?
Yeah, it's tricky. So I guess there are two things. One that Rob will remember well that are not on the typical menu or maybe wouldn't have been 5 years ago. One that's interesting for us has been where you have a partnership with a corporation actually buy a company. That's what we did with Cencora. We bought OneOncology. That was a fantastic outcome for Rob and the OneOncology owners, but also for Cencora. And I think it's not going to be every situation, but when it works best is when there's some kind of problem to solve, or your solutions capital is another way to say it, which is Cencora is some of the best in the world at moving product around and other things, but they hadn't owned a lot of provider businesses. And this was a big bite. And so they kind of wanted to incubate it outside the mothership for a period of time, have some benefits of the connectivity with the parent in terms of drug contracts. And I think they would tell you that they're thrilled in terms of the ways we've been able to partner, grow the business organically and through M&A. And so that's really a win-win, both for the corporate, as I mentioned, and then for us having a clear path to exit. And so I think it works really well on both sides. And we've actually done 3 or 4 of those. Kindred was buying a home health company. The other one I'd mentioned profile is continuation vehicles. Without getting too technical, I think the problem that solves single asset continuation vehicles is that when there's a company that's just doing great and it's cruising, but your LPs, your clients are telling you they want liquidity, what you effectively do is give them an option. As you say, the private equity firm, want to keep going. I want to keep managing it. But here I've got an option where you LP can either keep going with us, or if you need the liquidity, go ahead and take it. And that's been a really hot market because I think it does bridge the gap of a lot of us believe our companies have really interesting secular growth and that maybe we're waiting for a different multiple environment. You know,
Nick, how much are you doing right now in some of these more exotic transactions versus just a straight M&A trade? Are we really seeing a lot of activity?
We are seeing a lot of activity. Some of these deals that you see getting announced, they take anywhere from 6 to 12 months of buyer getting conviction. And then look, in other cases, it's the M&A version of product market fit with some of these transactions that lead to some of these spike bids. But yeah, I'd say there's a team on the 31st floor of the new JP Morgan Tower in Midtown that's burning the midnight oil right now. And it's certainly busier. Here we are going into mid-December than it has been at any point in 2025 for us.
And so we have probably several hundred CEOs and founders on the webinar right now. How would you counsel them to even begin to think about that kind of a strategy?
Look, first and foremost, you see a transaction, and I think a lot of people immediately look at the multiple, they get really excited. They think that's a comp. We're just like them. We're doing the same thing. But I think I just made a good point, which is some of these deals are the same as product market fit. Sometimes it's just the right target for the right buyer. So I think you've got to approach by first moderating your expectations before you go to market. These are massive undertakings for management teams. No matter what bankers will tell you about how much of the burden we will carry, it is still an enormous burden on management teams. Supplying all the data requests and information requests to satisfy buyer diligence. It's all these management presentations, fireside chats, if you go that direction. So it's just being realistic about the commitment. I do also believe that for a lot of the earlier stage companies, I don't know that they're going to benefit from the typical auction process as opposed to, look, focus on running the business, focus on the things that really matter to you and your employee base. And I think the right buyer will emerge. And I'm not suggesting hope as a strategy. You build some of these relationships over time, and you got to basically judge on the body language and the tone of those interactions where there's some real seriousness. And look, you've got two leaders in the industry representing pretty big portfolios of what I see as buyers for a lot of these early stage companies. That is a trend we are seeing. It's happening more and more. And I think historically, a lot of people haven't thought about PE-backed businesses as buyers of these earlier stage growth companies for the reasons I was talking about before and that Rob mentioned. There's not the appetite to absorb that burn.
Yeah, and as I've talked about, and obviously you helped with the Smarter DX, and we'll hear on the next panel some of those CEOs. That has become for us a really interesting path to liquidity. And that's a very different transaction than maybe 5 years ago. So Rob, some of your more scaled assets, you think about 2026, how are you counseling those teams? How are you positioning those companies? Are there must-haves that they have to be able to point to?
Yeah, look, I think the focus on fundamentals, the focus on unit economics, depends on the business model, how we would define that, but making sure you've built a really strong and defensible case around the durability of that aspect of the business. Then, of course, there's the growth that helps, as Nick mentioned earlier. I will say there's a lot of preparation involved. I resisted the urge to ask if the 31st floor at JP Morgan is where the new Irish pub is that I heard so much about. It's like a year of work. If we think we're going to have a recapitalization or a big capital raise for something in the portfolio, we're starting to talk about it and work with the management team at least a year in advance. Usually we've hired advisors at least 6 months in advance. And it's to go through all of that prep, but to make sure we've got the story tight. But furthermore, and it gets a little bit, I think, to what Nick was describing on product market fit, we think about it as like problem solutions. And you should be thinking about how do I strengthen, if I'm an entrepreneur, I'm thinking about how do I strengthen my product offering, my value proposition? How do I tilt the competitive landscape in my favor? And maybe that's selling to a strategic buyer where I'm the solution to their problem, a little bit like the solution capital approach that Catherine mentioned. But maybe I just need to find a dance partner. Like I'm doing what we do great, but if we could put this in combination with this other business that does something, and we're seeing this with the sort of AI adoption within revenue cycle, the combination will have a strengthened value proposition and capture market share faster than the legacy competitors. All that takes a lot of legwork up front and a lot of time spent unpacking the industrial logic and getting conviction and getting alignment across the management teams and the shareholders.
But that has been a truism of the rule of 40. If you're sitting on an asset that doesn't quite clear that bar, do you wait Or is there a way to sell through that, any of those deficiencies? Again, back to the false positive, we're seeing a lot of return of buyers in this market where they're more forgiving.
I think that they're also being really disciplined. We track precedence by everything, and you're not seeing many assets selling that aren't growing north of 10%. There are products and capabilities that might be a great fit for a buyer, but every buyer has a lot of the same things in mind that your companies have in mind. That they need to manage growth because they want to go public. They want to sell to somebody eventually. They're already public. They've got to manage growth.
And Nick, your database is exceptional. I've had the good fortune of seeing some of that data. Companies above and below the bar, there may be a 300 to 400 basis point difference in multiple.
Oh, for sure.
It's a pretty punitive market if you don't clear that bar.
Right now, it's almost binary.
Yeah.
I mean,
Catherine, I cut you off. Go
Yeah,
ahead.
and I would probably take the other side of the rule of 40. Like our investment committee sort of makes fun of us when we come up with that because it's like an artificial line is how we see it. And like that there are so many other factors beyond a pretty narrow measure that fit into that. But we may be in the minority. I think all the factors people mentioned are right, but that felt a little maybe, and it's not like the data is not in my favor on that. But the other thing I would just say, like to the founders and CEOs out there, is that the thing to always remember is companies are bought, not sold. And so it's a pain, I'm sure, to spend time with prospective buyers when you're not in a process. And like, you never know if they're going to be the ones who are trying to run your business. But particularly for strategics, like a lot of it comes down to timing. And so it's sometimes hard to force them to move, or they need a really long time to educate their board about the space you're in and get conviction. And so I do think it is time well spent to do
Can I
that.
ask we have less than 2 minutes, just quick answers. Are you a net buyer or seller, do you think? Will you be a net outflow or inflow from your practice areas?
Net seller, because we're trying to sell a lot more for our people. Nick, I'll call you.
I think
Be a
that you're
net seller.
active I think active on both sides, but certainly very much in business and a buyer.
I think it's going
Closing thought.
to be extremely active. I think we're going to start off just like we did last year with a lot of activity, and barring another Liberation Day or some kind of black swan event, all the markets are cooperative. We've got a couple of things out there that we're worried about, but market hasn't felt this good for this long in a few years.
That's terrific. What a great way to end the conversation. I can't thank you guys enough for joining us. I'm going to transition over to my partner, Parth Desai, to talk to the founders that we get the privilege of backing. Thanks, everybody.
Thanks, Mike.
Thanks so much.
All right.
Be well.
Awesome. Thanks, Michael. Nick set a bullish stage for this conversation, so really excited I want to welcome Anik, Kyle, and David to the spot. Really fortunate to be joined by all three of you today. Each of you is building a significant business, in part powered by an organic growth strategy. So there's going to be a lot of well-informed perspectives that we want to get into. So let's dive into it. The first topic I want to hit on is where M&A fits into your broader strategy, specifically what signals in the market or within your business inform your decision to buy an asset versus build or partner. And Kyle, I want to start with you. Datavant, I think, is a health data and collaboration platform that's touching almost 80,000 care delivery sites now. And you've had a very deliberate sequence to your growth, right? You built the data pipes and connectivity, and you moved up market to tap into analytics budgets via the acquisition of our portfolio company earlier this year. Can you just talk a little bit about the philosophy and approach?
How to do it? I'll go over M&A strategy a little bit. So as you mentioned, DataMan, massive data collaboration platform. We're the largest kind of mover of data between hospitals, health systems, payers, life sciences companies, legal and insurance, and many others. We sit uniquely in between the supply and demand side of healthcare data. And so much of what we do and so much of what we built out are collaboration tools and other things to allow folks who want to get access to data to manipulate it, to summon it to begin with, right? Because it's very hard for folks to be able to get access to it just in this market. And it's gone very well. And I would say the thing that has shifted over the last 2 years, almost since I've been at Datavan, and Ation's a great example, just the pace of digitization and the sheer amount of volume of digital data that's hitting the market has overwhelmed, I think, a lot of our partners. And tools like Ation have been great examples of where you can bring in a new solution set or a new company and help take something that was focused on just epidemiology and cohort building and extrapolate that into a way broader and more cohesive analytics platform. And so we've had really robust adoption, I would say, across almost all of our life sciences base. And I think the thing that differentiates us more than anything, and something that I think is very important, and I had the opportunity to go sit down with the new CEO of Oracle a few months ago. His point of view was distribution and access is going to be everything in the future, and in particular in healthcare. And that kind of vertical SaaS and workflow tools like we've thought about for quite some time aren't going to fit the bill. And so one thing we've been able to do really well through a lot of this M&A is use that distribution and scale that you highlighted and I mentioned as well. And I think that's something for folks to pay attention to as they're working through their own strategies.
Yeah.
We can see you now.
Awesome. Yeah. Sorry, I hopped back in and out, but hopefully it reset itself. David, I want to ask you the same question. You're obviously building an intelligent operating system spanning pre to post pay at Machinify here. And Catherine talked about this concept of infusing AI into established businesses. And you guys brought together Rawlings with Pixio and Veris, and obviously the AI with Machinify followed by Performant. How those capabilities come together? And again, talk a little bit about your philosophy and approach to M&A.
Yeah, no, I appreciate it. Thanks, Parth. So yeah, Machinify, we're really focused on becoming a healthcare intelligence platform. And as you mentioned, we looked at this segment of payment integrity and overall intelligence on the payer side and really saw a lack of true innovation in the space. So when we brought together the first three companies, which we did over the last 22 months, so it's been a pretty short period of time that we've done this, we brought together Rawlings, Apixio, and Veris. And then we sold a piece of it to Datavant of the Apixio business on the risk adjustment side. It really focused on the core competencies. So we had data, we had the products, we had scale. But one thing that we were really lacking is a true killer platform in the AI platform that was really going to power and bring these three companies together. And so we went out and found a founder-like company, Machinify, that had been doing AI work for the last 12 years, but hadn't got the real scale and as much data as they possibly could have on their own. And so we made a pretty aggressive offer to get Machinify on board. Now it's our core platform across our entire business, driving everything from the legacy Rawlings business through Apixio and Veris. And so we did that acquisition, which was smaller from a revenue standpoint, but very strategic. We even took the name of Machinify to really signal to the market of a differentiated asset within this payment intelligence space. So that was a different one. And then we really figured out that we needed to really find additional TAM and additional market space. So we acquired a public company, Performant, that really got us into the government space. So we've done some really unique deals over the last 5 that we've done together, whether it was a public company and taking a part of this private Machinify business, or just buying the platform and the AI platform that's now powering the whole business.
And David, you made a point that was really interesting. And I'm curious for a quick 30 seconds to unpack this a little bit more. How have you thought about infusing this technology across all these different assets? Do you let these businesses operate independently for some period of time? Is there a deliberate sequence by which you bring the technology to the other businesses that you folded onto the platform?
Yeah, it's a great question. Our philosophy is to move quickly. We're on a fast time period. We move quickly as a company. We've taken the Silicon Valley speed of Machinify and infused it through some legacy businesses that have been around for 40 plus years. So we rip the Band-Aid off when we go into an acquisition, make it clear with founders of what's going to happen. I'm proud to have 4 of the CEOs of the 5 acquisitions that we've done work for me and part of my management team. And I think it's about setting the right expectations up front. I did a lot of work looking at failed and successful integrations of tech companies into larger scaled, more tech-enabled services and even services company, and how you actually make a successful transition. I think the key there is to move quickly and have the right expectations set up front with the founders and or CEOs. And that's really paid dividends to us as we've gone about it, because everybody's on the same page, working towards that same vision of where we're going together.
Yeah. And maybe over to you here, whereas Datavant and Machinify, right, have been built infusing technology into long established businesses, Fabric is unique in the sense that I think you all raised $60 million Series A last year and then explicitly earmarked some of that capital for M&A. And it's a unique strategy, right? One in the, maybe I'd say we don't typically see at this stage, but is this a playbook other founders should be pursuing?
Yeah, I can't guide whether or not someone else should pursue it or not. It's a very unique, I think, an interesting strategy. We actually started doing M&A in our seed round, believe it or not. So we raised a $20 million seed round led by Thrive Capital in 2022, 2023. And in early 2023, we actually met a company called Hypnosis, which was at the time owned by a publicly traded health plan, Bright Health Group. And very quickly realized this is an opportunity to accelerate what we're doing from a product and technology capability and also give us additional capabilities. And so I think Fabric, just to back up, is we've taken really a full stack approach to using technology to create healthcare access with virtual care and connectivity to providers. And I think we've simultaneously tried to take a buy and build approach. So I think when you think about the buy versus build, we were like, let's just do both somewhat simultaneously. On the build side, it's been taking this kind of AI native approach to building. And I think we fortunately had a team of engineers, product managers, data scientists, and designers before we even started doing M&A. And I think the M&A has been somewhat opportunistic for us. And again, it's a little atypical for a startup to be buying startups, but we've had the fortune of transacting with counterparties that have been public companies like Bright Health Group and Walmart. Just by way of example, we've transacted with PE-backed assets. We bought Blackstone-backed portfolio asset called Team Health Virtual Care last year as well. And then we also bought a venture-backed startup called Giant last year. And then we bought another venture-backed startup called UCM this year. So 5 acquisitions that we've announced over the last 2.5 years. And I think what it's unlocked is distribution to health systems, health plans, employers. I think buying some of the proof points, like buying pioneering early companies, getting into buying market share, buying vertical market entry, cracking into health systems or health plans or employer groups as a seed stage company is a difficult tall order. So being able to accelerate some of that in terms of customer relationships and proof points, I think has been really accretive to us as a business. And then also getting capabilities that would have taken us years to go build. Just for one example, we bought a provider group last year that really allowed us to become more full stack. Even with all the AI advancements, healthcare delivery is certainly not a health software only endeavor. And so being able to have actual physicians and nurses and allowing us to become more of a multi-specialty offering just really added fuel to the fire in terms of what we were able to deliver to our customers. So yeah, M&A has been great for us from that perspective.
No, and it's a really interesting point. And Michael mentioned this on the earlier panel. We've got a few hundred founders here in the audience today who are at this moment in time, right, talking to potential strategic acquirers, maybe even some of you here on the Zoom and thinking about M&A as a growth enabler. And I think what they're all wondering is how do they position their business to partners like yourselves, and what specific signals should they lean into to help distinguish their businesses? And Nick talked a little bit about how growth is getting a premium in the market today. And Rob made a really good point about how the investment appetite right now for high burn businesses is almost zero. And so how do you strike that balance? And Kyle, I'm going to ask you this question first. What are some factors that maybe are salient across all the businesses you've talked to that have gotten you excited, or maybe the inverse of that, which is what do you see that makes you walk away from a business?
Yeah, I think it's 3 things that really differentiate a great acquisition. And it's agnostic to, I think, a lot of financial and other measurement. But to me, what matters first and foremost is and it sounds trite, but I think it really matters. Is there a real team or someone that you're inheriting, especially if you're going into a new space or into an area or a market segment that you need to lean on? Aetion's a great example. We picked up a brand new head of product and a brand new head of science for our entire life science division as a part of bringing Aetion over to Datavant. Things like that are extreme drivers of value, right? And Nicole, just as an example, she was at Pfizer for 25 years, wrote the book on epidemiology, was the architect behind so much of the software and all the customer relationships. You can't really put a number on that, right? And so getting those relationships and having those anchor points in the deal matters a lot. Second, and I think that it's something David and I've worked together a long time. It's something that he and I have always partnered on through all of our various companies, is really getting the business case or the unit economics all the way down to the operational level. I think a lot of folks gloss over with a high level, God bless Nick Richard, but banker math Excel spreadsheet that just shows up and to the right. That's not going to cut it, especially if you're trying to underwrite a model with a lot of rigor. And so I think it's getting down to that industrial logic that matters a lot. And then finally, and I think people are very short-sighted about this, and I think that we as an industry in healthcare have gotten too cute, but incentives really matter. And drive incentives, drive alignment, get the new teams and when and where you're integrating inside the business lined up, spend a little bit of cash to have a lot of impact. I think a lot of people just try to take a shortcut, cheap out almost a little bit, whereas you can make a huge impact. And especially at the speed all three of us are talking about, we're doing acquisitions. I think getting that stuff lined up early and often is really important as well.
And David, I'm going to ask you the same question. You and Anik have both bought assets, in some cases divested from publicly traded companies, in some cases emerging startups or scaled assets. But do you agree with what Kyle laid out? Do you have a different philosophy on factors that have been salient that got you excited about businesses?
Yeah, I agree with Kyle. As you mentioned, we've worked together a long time, but I think what he hit on is really important. The team, companies I've walked away from this year after looking at, if it's only a founder and it's only the CEO and not a really great team around them, we've looked at companies that match our vision. So it has to fit in our vision of where we're going as a company. And the best ones, the ones that we take the largest look at, are ones that accelerate our ability to reach that vision. So we're trying to move the payment cycle much more forward, shift left, eliminate all the back and forth and friction that's within healthcare. And if you're not aligned to the vision, so the founders and CEOs that are trying to sell, if you're not aligned to the vision of where the larger company or the buyer is really going, it's not going to be a fit, regardless of how great your business is or how much revenue growth you have. And if you're a rule of 40 or 50, if it doesn't fit with the overall story of where you're going as a company, it's not going to work. I'd agree with what Kyle said. I would also say just where we've been able to really add a ton of value in companies is actually those synergies. When you start looking at it, why we've been probably more competitive and won some deals past, I'd say, sponsors and others, is we have a ton of synergies, and what we're building is a great company at Machinify. So being able to have cross-sell, to be able to have a team that you can bring into a platform actually allows us to pay a little bit higher prices because we can see such great synergies and really manage the unit economics that Kyle mentioned.
And on the previous panel, we also talked a little bit about AI premium. So, Anik, I'm going to ask you this question because I know some of the assets that you guys have acquired have brought that story to your business. How much does the AI story unlock a premium for the asset you're acquiring? Or maybe said another way, it's really hard to even differentiate different AI solutions, right? Giant, obviously, was a company you acquired, has a bunch of competitors in the market. How did you isolate that this is the asset that was the right fit for your platform?
Yeah, it's a great question. I think maybe just to reframe the question a little bit, like I think AI is definitely a part of the evaluation criteria, but it's not sole evaluation criteria for us. For us, I think it comes back to actually what Kyle and David both brought up. Is there a good culture fit? Is there a good product here? Are there good outcomes? Are the customers happy? Is there a good talent fit? We try to really do our own underwriting based off of the market size and the cross sell to our distribution base. And I think from a team perspective, we've really put together, we have a small kind of corp dev team at Fabric, which I guess is also atypical for a seed stage startup or Series A startup to be doing. And so for us, it's like opportunistically sourcing. We spend a lot of time spending time with bankers like Nick. We spend time with startups, with VCs. We have a lot of founders actually just do direct outreach to us about, hey, like we're thinking about strategic options. Would you like to be in the consideration set? And I think as we do that, we get to see a pretty rich view of the market. I think this year we've probably looked at over 70 deals just by way of example. And I think when you see that quantum of opportunities, it allows you to better stack rank. Oh, this is the right fit for Fabric at this moment of time. And going back to what makes a good fit for us, it's all those factors that we described before, but it's also just like timing and making sure that our team is bought in. And so part of our strategy here is also our leadership team is all like bought into M&A as part of our core strategy. They help drive major diligence decisions. Our employees know that M&A is a big part of our growth strategy. Our product team knows that there are capabilities that we may have on the roadmap that we could accelerate with opportunistic M&A. And so being able to, I think, be transparent with your team around that also helps make sure that you're making the right decision at the right time for the company.
And each of you has talked a lot about team. And so I want to go to the topic. Choosing to sell a company is a hard decision, right? And if you're a founder in the audience here today, what signals should you even be thinking about that alert you to the notion that, hey, this is a good time to sell? And then, Kyle, I'm going to ask you this question first. How do you work with founders to align the right incentives to get them the decision to sell and to ultimately partner with Datavant?
Yeah, look, I think a few things. I've mentored and talked to founders in healthcare for a long time. And when I was at Athena Health and we launched More Disruption Please so many years ago. I remember standing with Bill and Michael when Flare was getting launched in the Liberty Hotel ballroom and just talking about distribution even back then and how difficult it is and how so many founders hit this wall. And I think what's exciting for a founder and where I've made a lot of traction, I've been fortunate to be at my last 3 organizations had a bit of size and scale and a customer base to cross-sell into, et cetera, that you can underwrite something really excited with them and show them that there's some upside. I think if you get into an earn-out type situation, keeping it clean and easy and fair is super important. Just attach it to something that's very straightforward, like revenue or something that's very straightforward and people can understand. I think we've probably done about 5 acquisitions in the last 2 years as well. And we've had several founders, and I think there's a big appetite to roll as well. And I think folks, at least in and around my business and the space that we occupy, are seeing this digitization curve of health data start to really spike. And they're realizing that it's unlocking new use cases. It's unlocking propensity for AI and all of the hype cycle to really pick up and drive value potentially too. And they want a piece of that. And I've not seen as much full cashing out as I've seen in the past. I think it's a great example. Like this, you're not finding the founder that's been in the business for 20, 30 years as much anymore. These are newer, younger companies, and they've got big ambitions too. And the vintage shift has happened a little bit. And so I think capital and structure has changed a little bit along those lines as well to make sure that it's more in sync with what folks are looking for.
And how is it ever too early to start building a relationship with a potential acquirer, Kyle? When's the right time?
No, I don't think so. I think Rob said it earlier, and I couldn't agree with him more. Dave and I were both at CVS for quite some time after we sold Signify there, and getting to watch corp dev inside of a bigger organization like that, they're just inundated, right? And educating them and spending time with them and building relationships with them has a ton of value. It can lead to sales, but it can also, if there's a big process, when we kicked off the Signify process, we had 21 folks bidding. David and I lived downtown for weeks and washed our clothes in the hotel at the end of COVID. But a lot of those relationships part that he and I and Matt and other folks hold at New Mountain had for quite some time. And I think it matters a lot. You don't want to be starting on first base with a big corporate and a big process like kind of surge because someone else comes in. There needs to be some familiarity, I think, if you're going to have a shot at building a relationship or doing a transaction with them.
Now, it's a lot of good points in there. And I think the other side of that, David, I think is that some founders just face this consternation, this fear about fit and losing control post-merger. And I think there's some deliberate things that you and I talked about on our prep call about culture and what your teams are doing to mitigate avoidable friction after the merger closes and as you, again, start to fold some of these assets in and drive synergies across the combined entity. Could you talk a little bit about that?
Yeah, they're all different, right? So while we have a playbook on integration and we run that playbook, the cultural elements and the strategy is often different. And take a look at 2 deals that we've done at Machinify. One, acquiring legacy Machinify, which was a smaller organization in terms of revenue and people, about 150 engineers versus one company I acquired at 2,000 employees. So you have to look at them each individually and take the perspective of, is this individual, the CEO and founder, going to fit within this team environment? That's number one for me. Are they going to fit? Do we have the shared vision? And while we are rolling some of the equity over in most of the deals that we've done, in some cases they're not, right? And you have to believe and build that relationship up front to really trust the individual that they're in it for the right reasons. And we've been able to find CEOs that really want to build something greater. They truly want to change the administrative process around healthcare payments and admin. And those individuals, while it's going to be bumpy, I'm never going to lie to a CEO and founder, that's going to be an absolutely smooth sailing coming into a much larger organization. As long as you're in alignment around the incentives that Kyle talked about. And for most of our deals, we look at strictly gross profit of the combined entity versus what one division coming in will do, because I want all my leaders working as one team together. And that really makes a difference. So the incentives, the relationships that have been built over the years, and then truly trusting one another to build something great together has been the most important and impactful for us at Machinify.
Yeah. And I know we've only got a couple of minutes left in the conversation, and I want to kind of turn the page to thinking about what the next handful of years look like. We're in this world now where moats, product moats are becoming thinner, right? Roadmaps are colliding faster than ever in this world of AI. And I'm curious how each of you continue to think about positioning your platforms in this world. Where are the opportunities to continue to protect those modes and drive an advantage longer term? And where do you think those modes are fastest to erode? And I'm going to do a rapid fire. Nick, I'm going to start with you and then go around.
Yeah, I think there's part of the consolidation opportunity with M&A is actually to reduce the number of vendors a customer has to work with. And so being able to reduce the points and solution sort of friction, and then also be able to consolidate in a way where the point solutions actually integrate with each other, I think is part of our vision and strategy. And I think also something that every buyer is looking for. And I think the laws of physics in healthcare, like each of those point solutions took years to probably get built and integrated. So being able to just do that much, much faster is something that I think drives winning platforms.
Again, thanks, Nick and David.
Yeah, I think when you're looking at companies, you have to decide, are you adding a platform? Are you adding products? Are you adding data and scale? And do you already have the platform? At Machinify, we have the platform. So for us, we're looking at unique products. We're looking at TAM expansion, et cetera. I do feel, to Nick's point, that there is a lot of consolidation. We sell primarily to payers today. There is a lot of vendor consolidation. And we're positioned to take advantage of that because we have end-to-end solution across the board. So I think for people looking to sell their business, it's how do you add additional capabilities and products to those winning platforms that are going to be there in the future.
Kyle, I'm going to give you the last word.
Yeah, no, I agree with, I think, a lot of what's been said. I think the industrial logic of how you're going to integrate is really important. And I think when people really fail, David just alluded to, is when you're just trying to slap something together, you need to decide what's the right product market fit, what's the distribution channel going to look like, how the incentives going to get laid out. But to me, more than anything, like, I think you want stuff to be cautious because everybody claims they're a platform these days too. And David's right. You got to pick what true north is, what's going to be the system of record, what's going to be the kind of anchoring operational system, and then go from there. And I think that a lot of people get that wrong. And I've seen a lot of people waste a lot of money and spin a lot of wheels and divest a lot of businesses as a result.
Awesome discussion, guys. Thank you for sharing your insights. We're excited to keep learning from and following your successes. So all the best to the three of you. And as our panelists start to drop, I want to thank all of our speakers once again. This is a dynamic moment for healthcare technology, but also, as you heard from everybody here, lots of opportunity ahead. And we realize that all that potential and collaboration across the ecosystem. So thank you all for joining. You're all contributing to that. Please don't hesitate to reach out to our team here at Flare Capital if you want to continue the conversation, and keep an eye out for our next expert roundtable, which is going to take place on Tuesday, March 3rd, 2026. Thanks, everyone. See you soon.